So we're going to revisit the electric vehicle space in this video, and I want to talk specifically about Switchback Energy and ChargePoint, which are actually in the process of becoming one company through a reverse merger. Sort of like an IPO, but not really. I'll explain why in the video. We'll get into that. We'll get into the specifics of both businesses, what they are, how they operate, and more specifically ChargePoint. We'll take a close look at the bull case for ChargePoint, why you would want to buy, and we'll take a look at the bear case, the risks that you have to be aware of, and why you might want to stay away. Let me tell you my thoughts. So first, let's talk about Switchback Energy. They are an SPAC, which has nothing to do with a political action committee. SPAC actually stands for Special Purpose Acquisition Company. And so basically, they are a shell company that was incorporated about a year ago. They went public in 2019, but they did nothing. They had no business. They were just a shell with a mission to go out and find a private company to acquire and then essentially become that company. So it's kind of like going public first before you actually have any kind of business whatsoever and then snapping up an online business. Now that said, they did know at the time what they wanted. They wanted an EV company, they wanted a charging network specifically, and they found one in ChargePoint. So they're in the final stages now of negotiating the acquisition of ChargePoint, and when the merger happens, the public company that is SBE today will become the public company that holds all of the assets and the entire business of ChargePoint. There'll be one company go forward. The interesting thing about this is that you can own Switchback today. In fact, you could have owned it a year ago before you even knew what it was going to buy. And some people absolutely did. They bought in with the expectation that it was going to succeed in acquiring a good, solid EV charging company go forward. And those folks had an opportunity to get in super early and probably make a ton of money. And you can see that from what's happened to the share price over the last little while. As soon as the potential merger with ChargePoint was announced, the stock price spiked on the expectation of what value would be created in the merged company. Now, of course, the other reason that price spiked is that ChargePoint is seen as a solid business. It's a really key player in this EV space. They have a really wide-ranging charging network. They're super entrenched and they're way ahead of a lot of competitors in this space. So people thought it was a really good decision of Switchback to make this acquisition. And ChargePoint has a history as well. They go back to 2007. They were founded back then and started growing out that charging network because they knew what was coming. And they do have the largest network anywhere. They're in 14 countries around the world, and right now they have somewhere around 115,000 charging stations with plans for massive growth and expansion. Their goal is to add 2.4 million charging stations to that network by 2025. And they're not just all about the charging stations. They also sell charging hardware directly to consumers, so you can set up your own little charging station for your vehicle at home. And they're in the commercial business and the fleet support business as well. So they're very tight with business and consumers. You can buy their charging stations today at retail, and they're absolutely an established business. They're out there making money today. There's also a nice recurring subscription software and service model that they can sell both on both sides of the business, on the B2B side and on the consumer side as well, that gives you access to reports, utilizations, all kinds of stats, and cloud-based services, support, and then there's an opportunity for them to tap into that consumer market and the commercial market ongoing and leverage that for additional services into a hugely expanding market. So I think that's where people are seeing the key growth for ChargePoint is the EV market and the spike that's projected for that market go forward.
What's the upside potential?
So the bull case, of course, is all about growth. We're in the early stages of this technological revolution for EVs, and the market projections are absolutely enormous in terms of what's going to happen as the reliance on fossil fuels in vehicles goes down and as the adoption of EVs goes up. You're going to need to be able to charge these vehicles go forward. So, a buy on a company like ChargePoint or Switchback, as it will become very soon, is sort of what they call the pick and shovel model. So back during the gold rush, they said, the smart money is not to be made in mining gold, it's to be selling picks and shovels to those that are mining the gold. And that analogy is often used in the EV charging network space because it's all about building out that ancillary infrastructure and not taking on the more substantial technological risk associated with building vehicles and autonomous driving systems and all those things that are super hard to do. Building out an electric vehicle charging network is not as difficult. Another thing supporting the bull case are the headwinds in terms of environmental regulations. You know, governments around the world are pushing aggressively to be carbon neutral or carbon negative into the future. And those tighter regulations on emission producing vehicles are really making it difficult to continue producing gas and diesel consuming vehicles. And manufacturers are responding by aggressively moving into the EV space. So it's not just about Tesla, NIO, any of these companies that are in the EV space producing vehicles, but you know, GM, Ford, everybody is in the business now of making EVs and growing their EV market share, all the while reducing their production of gas and diesel vehicles. GM alone is projected to have, I think, 20 additional EV models by 2023. That's happening very, very quickly, and the other automakers are doing the similar thing. So those vehicles need to be charged, right? Which is a key underpinning of the bull case for ChargePoint. And EV growth is not only significant, but it's also ramping up faster than was initially projected. When you look at some of these estimates of the total addressable market size, they're not only huge, but they're increasing. These estimates are constantly being revised as the growth rate is accelerated. It's a pretty fantastic growth story when you have growth on top of growth. And you know, the competitors are way behind. I think it's a key driver of the beginning of a wide moat situation that's developing right now in ChargePoint. They're 7 times the size in terms of the charging network of their closer competitors. There are competitors out there, but most of them are way behind ChargePoint. So to have this big of a lead this early in the game is pretty significant. It's going to be really hard to catch these guys. And you know, in spite of that difference in the penetration into that market, the price to sales ratio, so the valuation that's attached to ChargePoint, I think the price to sales metric is it's looking at about 34 right now, and Blink, for example, has a price to sales of 62. So, you know, given that difference in valuations and then compare that to the difference in the market penetration that they've achieved, it's really hard to justify that higher valuation for a competitor like Blink and the comparatively lower valuation for a company like ChargePoint. So in terms of comparables out there in the market, the valuation doesn't look that bad for ChargePoint. And another key point on valuation is the growth projection. So if you look at the numbers that ChargePoint has listed for some of their estimates of growth going forward, they're projecting close to a 60% annualized year-on-year growth out in the longer term. You know, they're talking out the next 7 years, recognizing consistent growth at those levels. If that's the case, some models would put that share price at well over $200, probably $220 if they can sustain that 60% year-over-year growth, which is hugely impressive.
Let's talk about risk.
So it's not easy to draw a bear case for these guys, to be honest. There's almost everything in their favor. I think if you have to go looking for a bear case, then I think first off, it would be valuation. So while the valuation metric, if you look at comparables for a company like Blink, it actually doesn't look too bad. If you tie it back to the fundamentals of the underlying business, the valuation would actually come in quite a bit lower based on today's values. And in fact, the current deal with Switchback would value ChargePoint at around $11 to $12 a share. And currently, the stock price of SBE is already well in excess of that, right? So above the fundamental valuation, there's already a speculative or hype premium that's attached to SBE today. So, you know, you have to wonder if that valuation is going to sink after the reverse merger / IPO event happens, whether that's going to drop down to a more fundamental valuation of closer to $11 or $12 is anybody's guess, but it's definitely a bit of a risk. There's another weak argument, I think, on the bear case side to be made around competing standards. You know, throughout history, we've seen this beta versus VHS, if anybody can even remember what that is, but there is some concern that competing charging technologies will emerge and one will overtake another and suddenly you'd be left with an obsolete technology. I can't think think that that's going to happen. Really, the adoption of those standards is being driven by the vehicle manufacturers, and it is absolutely not in their interest to create any kind of closed standard. They're going to make their vehicles compatible with whatever technology is widely available out there. ChargePoint's the leader, and I think we're seeing today that all of these vehicles are widely compatible. Even Tesla can be charged anywhere. So I really don't see that as a valid bear case argument. There are actually two arguments on the bear case that I do consider valid, though. One has to do with the actual utility and demand for charging stations into the future. So I think a lot of ChargePoint's projections and numbers are based on the current requirement for a charging station network, based on the range that we can get in today's vehicles. I think as battery technology continues to improve, we might see a weakening in that overall demand for the sheer number of charging stations out there. Now, of course, everybody that owns an EV is going to need a charging station at home, but the requirement for these intermediate charging stations at traffic hubs, or major hubs where cars will stop, long road trips, this kind of thing, that will tend to be reduced over time, I think, as battery technology gets better and better and better. So ChargePoint is going to need to focus back possibly on the core locations for these charging networks, which are at fleet locations, at homes, and perhaps some major centers here and there. But the actual utility of selling them into parking lots, malls, office buildings, I have to wonder how realistic that is as battery tech gets a lot better. The other much longer concern I would have in terms of the bear case for any EV charging network is the eventual rise of autonomous ride hailing, or robo-taxis, as they say. So, I think there's a ton of hype around that particular emerging technology. How far out that is anybody's guess. I think it's further than some people would like to admit. But regardless, I think when that day comes, I do believe it will come. And when it comes, I think the overall demand for vehicles is going to subside. Suddenly, car ownership is not required. You could hail an autonomous robo-taxi anywhere you want. So the actual utilization of an individual car would theoretically go sky high. There's no longer a vehicle sitting empty overnight. It's going to be out ferrying people around. So, the amount of vehicles that you would need in a future scenario like that is going to be less than what people are projecting, and therefore the actual demand for an EV network would also be less. That's a long ways out, though. I think the time frame for that kind of technological disruption is incredibly speculative, and it's not going to happen tomorrow. So what's the final word? Would I actually make an investment in these guys? At the current time, I don't think I would, because the valuation is still a concern for me. I think that there's a lot of uncertainty around this SPAC reverse merger situation. I think it's drawn way too much attention, and I'd really like to see that number come down. I'd like to see the hype fade, and I would like to see an entry point closer to that $11 number. Even if it dips under 15, I think that would be a fair price to pay. Even at that number, I think you could still see dips and volatility. You'll certainly see volatility on a go-forward basis. But if you kind of zoom out on your time frame and you look at this long term, I think this is a very solid long-term investment. I don't see these guys losing in the long term. It's just the short term that concerns me, and the volatility, the uncertainty, and the hype around the reverse merger that's happening right now. It tends to scare me off. I'd like to see lower volatility before I consider it an entry point. So that's my opinion, guys. I hope that helps. If it does, please give the video a like, subscribe if you haven't already, ring the bell, and I'll see you on the next one.